Hi, well, I don't have a lot of time to make a fancy video, but I want to explain how the concept of market making works. Because I see that online there's a lot of people that usually say, well, market makers, they take the bid and the ask, but they don't understand how this concept applies in practice, right? They just think that market making is only for high frequency bots or something. But the concept is very basic. You have to return to the start, right, where it all began. So for example, imagine you have a commodity like rice and, well, I hate to make these bad drawings in the chart, but let's do it. Well, you have the guy that produces the rice, okay? Let's say he's the farmer. And the farmer, on his own time, he goes to the city and he wants to liquidate, let's say, transform in money this rice that he had. But the problem is that there is a timing mismatch, right? Because at the moment he goes to the city, he may not find someone to buy his rice. But here is when the market makers comes in. Why? Because the market maker is accepting the inventory risk, believing that this commodity have a value, right? And someone will come after some time and buy the rice. This is the concept, man. Now the time between this transaction, let's say, of buying from one side and selling to the other side may take a lot of time in the past, right? Not at the moment. It depends on the liquidity in this market, in the volume, the demand, whatever. So this is the concept. You have a guy that takes an inventory risk. Now there are ways to mitigate this inventory risk, of course, but in summary, he's going to take this inventory risk and he's going to try to sell for a profit. The problem is that when you're market making, the price of the asset you're market making may go up or may go down, you know? This is normal. So you have to manage your, let's say, your cash distribution across different prices. Oh, this is very hard. What I'm saying are some hard and fancy words, but I cannot find better words for you. So let's go to the practice here. It's pretty simple, man. Imagine you are a market maker, and people. This is the daily chart, okay, of gold. I'm going to take the daily chart of gold, but it can be applied to any time frame. Imagine you're a market maker of gold because you believe that gold have an intrinsic value, right? So you think that it goes up across time and it's not going to zero. So as long as you can milk the cow, it's great, because at some point, even if the market falls, you're going to have some profits because you're managing how you distribute your lots, your money across different prices. So for example, imagine you are trading gold as a market maker on the daily chart, right? You want to offer big liquidity, so you're trading on the daily chart. Actually, if you have big liquidity, you go to lower time frames, okay? Notice the difference between the tops and the bottoms here. I will actually erase the candlesticks because candlesticks mess up with people's brain. You don't know why. This is my indicator, okay? So do not expect to find it anywhere. So this is how the market's behaving. You see the tops and bottoms, tops and bottoms, tops and bottoms. You can say that these tops and bottoms, they are some sort of bid and ask spread, right? But on a very big time frame. And tops and bottoms, they have this nature because they have this nature of participants usually putting stop losses where they are, right? So you can be sure, let's go to the most recent price action here. You can be sure that when you're looking in this chart, you have stop losses right here, you have stop losses right here, you have stop losses right here. You know, participants always put the stop losses at the same place. That's a fact. And your job as a market maker is to provide liquidity, right? What do I mean with provide liquidity? Well, it means that sometimes there is a high demand in the market that withdraws liquidity, right? And when I say demand, do not consider like, oh, offer or demand. No, let's say just demand because, you know, like, understand demand as take your volume, right? urgency to take the price wherever it is. So you know that at these prices you will have a withdrawal of liquidity. When it gets down here, people are going to get stop loss, trigger stop loss, right? So either they are going to try to trade the breakout to the downside, or whoever bought is probably getting stop loss here, right? In this moment of time, if the market reaches the bottom, there will be a lot of taker activity, and this taker activity will remove liquidity from the market. And your job as a market maker is to provide liquidity. The funny part is that you usually provide liquidity where people are getting stop loss. This is why market makers make some money, because you're trading tops and bottoms, you're buying low and selling high, you are managing your inventory and hedging your risk, and you're buying wherever they're getting stop loss, because you have volume to fulfill and you have liquidity to provide, right? So imagine the price comes down here. Where are we trading right now? Where's the pencil in this thing, man? Like I use this tool for a very long time and I still forget where things are. Well, anyway, let's make another method. So the price went from this region to the middle, and imagine that the price is going to do that, you know. Down here, you're going to provide liquidity. You have a lot of buy limit orders there that will for sure be fulfilled, because when this stop order activity starts to happen, it will execute your price. And another thing you know is that you are in a range, so probably it makes a bottom here, then it comes back and makes a top there, and probably here, and probably at most recent top, which is where the price is now, supposing that it went down from this point, there will be a lot of stop losses. So the spread that you take, consider it's a daily chart, is probably like 2%, right, in a daily chart. But this logic can be reproduced across different time frames. So if you open the 1 minute time frame, you notice that there are a lot of stop losses. There are a lot of tops and bottoms. You know, see, look at this amount of tops and bottoms being violated. And during the day, you know that probably there are let me see, 55, 49 breakouts. There are 100 bottoms and tops. Now this indicator that I'm using down here is taken from Synthesis Fractals 5.0, right? And I'm showing you guys at 2.0 because, well, you know, I'm not going to share everything. So the daily chart in 1 minute time frame for gold, at the moment there is 100 tops and bottoms. During the day there usually is 180, right? Now look at the spreads of these things. When we are talking about gold, there's a lot of liquidity in gold. You can't just move it easily. So usually the spread between tops and bottoms here are 0.06. You can make it a lot of times during the day. Now let's go to crypto, like Hex, you know. Let's take an example, like our gigantic example of spreads here. If we go to Hex, for example, the daily chart, you have these tops and bottom spreads of 40%. Do you understand that? Do you guys understand the spread? Look at these spreads in crypto, right? From this bottom to this top is 40%. Let's take another one. If you go to GRT, which has a lot of spreads too, from this bottom to this top, you have 20%, man. Now imagine if at each bottom you could allocate $1,000. Oh, but That's a lot of money because there's a lot of bottoms and tops. Yeah, you're right. And you need money to make money. That's the logic, right? But you can snowball it across time. Of course, if the price goes up and you're just buying and selling, you're buying bottoms and selling tops, at some point you're going to take a permanent loss. But you have to understand that it's market making is a trading strategy. Just like imagine you have an Airbnb in a touristy place. When do you expect to make money? Well, during the holidays, during the weekends. This is when the market is favorable to you, and this is your business, right? So for each type of trading strategy, you have to expect that some of there are pros and cons. And the main objective is to have a lot of trading strategies in different types of markets so they can hedge themselves. So when one is not making money and the other one is, when one is not don't have any trading activity, you have a bunch of others that are trading and probably make money. So and by the way, their drawdown must not be the same. But this is a very intensive topic which I'm not going to share now. I hope you understand this concept. It's really simple. The execution though is hard because you must code, you must have some statistic, you must have some indicator that tells you where are the fair prices, so to speak. And fair prices to me are always these prices where retailers get stopped because they need liquidity and I offer them liquidity. No problem at all.